The rhetoric into the sanctions was that U.S. was going to take a much harder stance than President Obama. They were going to be in it to win it. It was going to be brutal. Do the waivers change that conversation, and how?
I don't think so. I think they show a degree of flexibility, but I think they are very serious about expecting a path to significant reductions at the end of a period. I think they realized that they didn't want this to have a brutal effect on the market in the near term, but they definitely are serious about how they're proceeding to turn the screws, if you will.
Tom, is this a zero-sum game in this sense? If for the president to get what he wants out of Iran, doesn't the price of oil have to go up substantially? Is there any way to both have a low price of oil and prevail against Iran?
Well, from here we had a sharp reduction. So can it go up somewhat from here? Yes. But I do think the market is really concerned about what 2019 looks like, and Russia and Saudi both increasing along with the U.S. could put us in a more than fully supplied position next year.
Ashley, when you talk about significant reduction, it was 20% under President Obama, and it had to be reissued every 180 days for a waiver.
Yeah.
What do you expect this to be?
So right now, the best we can expect is about the same level is what they're aiming for. And this is where I actually disagree. I don't think Trump has been as hard of a line as he could have. And part of that's coming from playing this so close to the chest, by not saying what gets you a waiver and what absolutely does not get a waiver, by not saying who is and who isn't getting them immediately. This trying to be secretive actually makes it seem like they didn't have much of a plan, and now they're just responding to the fact that some countries kept importing all the way up until November 4th, so I guess we'll give them waivers. So, I don't know if they have a very firm line in mind. It seems to be a country-by-country basis.
So then the slide in oil, justified?
Yes, and I've been calling this slide for a couple of weeks now. I mean, markets are just overheated on supply concerns because it was a lot more speculative trading. It was the paper markets that really drove the recent price rally. Like you said, I'm keeping my $75 call for this quarter. We're heading into the lower winter demand season. We still have some trade tensions, some demand concerns heading into next year. And like Tom said, we have U.S., Russia, Saudi, all increasing supply right now.
So, Tom, it sounds like you're not terribly concerned, at least over the medium term, with supply. What about the demand side? I mean, there's some concern now that maybe global growth is slowing. What does that do to demand?
You're right on with that question. Basically, I do worry about that, and then the Goldman Sachs comments about softer next year are things we need to pay attention to. It wouldn't take much of a softening or a slowdown in global demand, perhaps triggered by the chaos of these tariff wars, to that, along with the restrictions on OPEC having been lifted. Everybody within OPEC who can do it is going to be producing what they can. Venezuela and Libya are the two that are, basket cases in terms of what's going on internally there. But beyond that, most of the others are going to see increasing volumes being okay, and they'll be there alongside the big ones, which are really Saudi Arabia and Russia as a non-member, but certainly a supplier to the export market.